I'm here in San Antonio for NAREIT's REITwise, our 2019 Law, Accounting, and Finance Conference. Joining me today is Readie Callahan, Head of Communications Strategy with Wells Fargo's LIBOR Transition Office. Readie, thanks so much for joining us.
Happy to be here, thank you.
Now here at REITwise, you were on a panel focused on interest rates, discount rates, and hedge accounting. Can you start by summarizing why the transition from LIBOR to SOFR is so important?
Thank you. Yeah, we take for granted how LIBOR exists in pretty much everything. Any variable rate borrowing that we do, whether it's adjustable rate mortgages, securitizations, floating rate notes, derivatives, I mean, it's a huge industry. So it's about 350 trillion with a T in LIBORs globally. And in the US, based on US dollar LIBOR, it's about 200 trillion. So the scope is just enormous. And it's really important to focus on how LIBOR impacts each client, what their LIBOR contracts consist of, how they use LIBOR, and that's really why it's important to focus on it.
Now, drilling down to the REIT industry specifically, what do you think is going to be the biggest impact from this transition?
Yeah, I think the biggest impact are contracts post-2021. So that's the date that is touted as the potential end of LIBOR. And I say potential because there's no specific date that has been stated by the regulators yet. So any contract that matures after 2021 could potentially be impacted. So it's important for the REIT industry to really evaluate those contracts maturing post-2021. So what do your contracts say? And oftentimes we think about, how can we continue a contract when the index is no longer available? And oftentimes that language exists in like the LIBOR definition or some part of the contract. And most documents never contemplated a permanent cessation of LIBOR. So you may have, like in floating rate notes, for example, it usually says if LIBOR is unavailable, use the last published LIBOR. So you're taking a floating rate note and you're essentially fixing it. And there's a whole range of different language. It's not consistent across the industry. And so it's important for individuals and corporations to understand what their language says. And if it's not sufficient, what do they need to do to make it more robust? And so the industry is really making a huge effort and has spent well over a year to come up with language both for derivatives and non-derivative products that will make those contracts more robust should LIBOR cease to exist.
And lastly, in addition to that, what are some of the other steps that REITs can be doing right now to get ready for this transition?
It really does come down to contracts. So I want to reiterate the importance of understanding what's in your contract. So it's really about evaluating how you use LIBOR. Is it in your revolver? Do you have a hedge? What does the language say? How can you negotiate better language in your contracts? As I mentioned, the industry bodies, so the ARC and ISDA specifically, are focused on recommending and endorsing language that market participants can use. And so it's incumbent upon individuals to read that language, evaluate it, and consider incorporating it. I also think there's a big component about, well, LIBOR will cease to exist. What can we use in lieu of LIBOR? And the best way is to actually move away from LIBOR sooner than waiting for it to just cease to exist. So it's about understanding what those alternative reference rates are and managing your interest rate risk, keeping in mind that LIBOR will no longer exist, whether it's 2022, 2023, sometime after 2021 it will cease to exist. And so it's important to understand the impacts on your debt profile.
Great. Readie, thank you so much for joining us.
Thank you.
For more information on this and other REIT news and analysis, be sure to visit NAREIT's website, REIT.com.